You know, every single person that goes into real estate or any business out there, they'll have one objective, and that objective is to effectively make money. You know, we all want to make money. Now, when it comes to real estate, there are four main ways to make money. Now, whether you want to make hundreds or millions or billions of dollars in real estate, which is actually possible, great. But if you just want to make some money, that's also great. But the whole goal for this video is to show you four different ways to make money via real estate, okay? And it's not just about, for example, I buy real estate, I get paid rents. That's not it. That's not all it is, okay? There are a lot more ways to make money from a single property, and that's why I'm making this video today. By the way, this year I went from being a homeowner to now looking to buy my first investment property. I sold my personal property that I actually lived in. Now I have cash. I'm buying some rental property, and that's why I'm making all these videos, because this way, as I learn, you learn, and we both kind of grow together. I don't mean to be corny, but that's the whole concept, all right? So the very first way, guys, to actually make money via real estate is going to be via appreciation. Appreciation is when an asset goes up in value. Depreciation is when an asset goes down in value. That's the whole idea. So you obviously buy an asset. The objective is I want to buy assets that appreciate. I don't want to buy assets that actually depreciate, unless you're doing it for some tax incentive reason or whatever. For the most part, you want things that actually go up in value. But most people don't know this or don't understand this. Assets by themselves, like an asset class, is not what determines whether the asset goes up in value or down in value. You might say, Tommy, that's not true, because if I buy a car, it always goes down in value. The answer is no, not true. If you actually buy a Mercedes as like a 2024 Mercedes for 60K, well, 5 years from now, it'll probably be worth about 30K. But if you actually buy a classic car, which is still in a car asset class, right? It can actually go up in value. That's the whole idea. So it's all about the individual deal. You can buy property that goes down in value if your projections don't work out the way you think it works out, okay? You buy a property in a abandoned place in Delaware that goes for 50K. You think it's actually gonna go up in a few years, but in reality, the neighborhood goes from bad to worse, and now you're left with a 50K property that's actually only worth about 30K now. That's also possible, okay? So it's all about looking for great assets that actually appreciate. So when it comes to real estate, you're looking to actually make about 5% a year in appreciation on average. So you buy a property that's worth 100K, you might be making an extra $5,000 every single year, just like that, via appreciation. Now, not 5K every year, because the first year will be 5K, but the next year will be 105,000, 5% of that, and then you have more appreciation, more appreciation. Now, it doesn't look like this, honestly. It might look like this in the real estate market, but it's always going up and up and up, and that's the whole concept. Now, you have two types of appreciation. You have natural appreciation, which is basically what I just described. You buy an asset, it goes up in value naturally. But you also have forced appreciation, which basically means I buy a 2-bedroom house, I add a 3rd bedroom and another bathroom. Now all of a sudden this property goes from being worth 100K to being worth 130K, because I basically force appreciation to it by adding extra value to this property. So appreciation is one way to make money in real estate, via natural or via forced appreciation. Now, number 2, guys, is actually going to be cash flow. Now, cash flow used to be a term that not many people spoke about, but then Grant Cardone was like, cash flow, baby, and everyone now talks about cash flow. It's kind of like a household term now, but cash flow is a super important idea or term or figure, and here's why. Because cash flow is the money you make after all the bills have been paid. It's the actual cash that goes into the owner's pocket. That's why they call it, for example, owner's cash flow. It's the money you actually make after all the bills have been paid. It's what lands in your bank account, in your pocket, all right? That basically means, for example, someone can tell you, I make $1,000 per month from this property. And you might say, yeah, that's your income, but what's your cash flow? And they might tell you, well, I cash flow about $100 or $50. You might say, well, that's crazy. But the answer is, yeah, they might make $1,000 from rents, but once you deduct the taxes, the mortgage, the maintenance, all the other stuff, they might only be looking at $50 to $100 in cash flow. Cash flow is one of the most important figures, because it basically says, hey, if you actually have positive cash flow, which basically means you have money coming into your pocket rather than having negative cash flow, which basically means, yeah, I'm having to put money into this property, okay? One costs you, one makes you, so you're able to buy more property if every property you buy makes you money. That's the idea. So cash flow is one way you actually make money from real estate. It's not about gross income, which is cool, or even net income, but it's about cash flow. It's the actual figure you actually get it in your pocket once you deduct every single bill associated with the property. Then you also have, for example, tax savings or tax incentives, which actually save you money, which lowers your tax bills, which is actually pretty cool, which actually nets you money into your pocket. Now, the thing about taxes is that you have no control over taxes in the sense that you could force appreciation, you have control there. You could, for example, raise the rents to increase your cash flow. You have control there. But as far as taxes, you have no control. You could say, I have a CPA, they're the best, but tax laws can always change. So that's why whenever you're buying a deal in real estate, taxes are like the cherry on top. All right. But they're not the reason you go ahead and buy a property. You shouldn't add, for example, tax incentives or tax reductions from this property to actually get you the cash flow amount. You should have positive cash flow without tax incentives because these things could be taken away from you. That's why you don't really want to include them. But here are some basic ones. You have, for example, mortgage interest, which is actually deductible. You have property taxes. You have insurance premiums, depreciation because of wear and tear. You have maintenance and repairs. You have utilities. You have legal fees and hiring professional like accountants. You have travel and transportation expenses and even office space. These are all expenses that actually help you save money on taxes that all come from this real estate property. But again, I would not go ahead and make a deal based on taxes. I would use them to sweeten the deal, but I wouldn't say, hey, my cash flow is $500 because of all the deductions, but without the deductions, it's more like negative or whatever, okay? You don't want that because you don't want to be basically counting on the government. Now, the last way to make money in real estate is going to be via loan pay down. All right. Now, whenever you actually buy a property, you're going to be given an amortization table, which basically is a fancy word for saying your payment schedule, which basically says, hey, if you buy a property for 100K, well, what's your mortgage? And within your mortgage, you have two things. You have capital, which actually is you putting money towards the actual property, it's actually paying down the loan. And then you have interest, right? So interest is, hey, the profit of the bank, how much money they actually make. And for the first few years, you'll see that you might be paying $550 as a total mortgage, but $500 goes towards interest and $50 goes towards, for example, paying down the capital, the actual loan you actually owe. And that's very normal because again, you're borrowing a lot of money, you're paying a lot of interest, and for the first few years, most of the money you actually pay is going to go towards interest, but then a lot of the money you actually pay is going to go towards capital. Now, whenever you pay the actual loan, that builds you equity because that now means, hey, I have equity in this property. So if you actually have a 100K property, you borrowed 100K, whenever you make a payment, let's say of $1,000 a month, whatever, and it goes directly towards capital, well, now you only owe about $99,000, which basically means you have $1,000 in equity because it's still worth that 100K, right? That's the idea between equity, right? So you make money via paying down the capital. So that's one way. So they have several different ways to make money in real estate, from appreciation, from cash flow, from taxes, from all the way down to capital pay down at the loan level, right? So these are all ways to make money via real estate. So don't just think that I'm going into real estate, I'm just going to make money on rents. No, there are other things that are actually going to increase the value of your property that's making you more money and making you wealthier and richer. These are all things you should consider. But the number that's most important, which tells you the value of a property, is going to be cash flow. That's the most important figure because an investment is only worth what it can actually give you and what it can produce. And it's all about net value. So that's also very important, or present value. I should say that. All right. But that's another video for another day. Thanks for watching. Like, subscribe, hit the bell to get notified. If this video helped you, and I hope it did, let me know in the comments down below. All right, comment down below it helped, so I know it helped you. And up here is another video. Over here is my face. As always, Long Term Team officially out. Peace out, guys.